City traders are actually betting on half-point interest rate cuts from the Federal Reserve this year, multiple ones. They say the Fed will ease policy aggressively if it sees a soft labor market, a wager that outpaces both the market and the view of the bank's economists. Well, joining us now with his thoughts on this, Bill Dudley, Bloomberg Opinion columnist and former New York Fed president. Here's my unfair question. You looked at the data, 25 or 50 in September?
Well, I think the logic for 50 is pretty compelling. The Fed officials have basically said policy should be neutral. The risks to the labor market side are equal to the risks on the inflation side, and they're a long way from neutral. But I don't think they're going to do 50. I think that a gradual approach is what they're going to pursue. Today, you had two Fed speakers, John Williams and Chris Waller, and neither of them, hinted that they might go more aggressively at this meeting. So I think the logic for 50 is pretty strong, but I think they're just going to do a 25 basis point rate cut in September.
If they don't do 50, does that significantly damage the economy until the next meeting?
I don't think so, because the market's priced in a lot of rate cuts between now and the end of next year. And so, we know where we're headed, to much lower short-term interest rates. All we don't know is the speed in which, how we're going to get there. And I don't think the speed matters that much, because, if the Fed's going to cut rates a lot in the next, 12 to 18 months, that gets priced into the bond market, that gets priced into mortgage rates. And so the economy gets a benefit of those rate cuts before those rate cuts actually materialize.
How much, Bill, do you think the Fed is actually concerned about the market reaction to this? The last time we had a major shift in monetary policy cycles, there was a lot of talk by Jay Powell about financial conditions, about the reaction function in the markets. Is that concern as present now as it was then?
Well, I think they view financial conditions as their friend right now, because financial conditions are easing even before they've actually been forced to act. And so that reduces the lags of monetary policy in terms of how monetary policy affects the economy. We've already seen long-term mortgage rates, for example, come down quite a bit. We haven't seen the consequence of that drop in long-term mortgage rates for housing activity, but at least that first stage has occurred where housing is more affordable now than it was a few months ago.
When we talk about this potential for the start of a major easing cycle, Bill, we'd be remiss in not pointing out that there are a lot of fiscal conditions, government conditions that the Fed is at least going to have to pay attention to, probably much more than they would have had if they had started this, a couple of years ago here. What's that discussion like behind closed doors when they have to talk about something that effectively they have zero control over?
Well, the Fed always takes the world as it is, not the world that it hopes it might be. And I think, if you look at the candidates' proposals, the Trump side in particular would really blow up the budget deficit over the next 10 years. The Harris is a little bit more ambiguous. And so the Fed knows that the fiscal stress is going to be probably sustained for quite some time. But it's probably not necessarily going to get worse than what it is today. I mean, if you look at the Congressional Budget Office, which makes projections over the next decade, they have them staying about the same level as a percentage of GDP, about 6% of GDP over the next decade. That's not good by any stretch of the imagination, but it's not, dramatically worse than what we have today. So I don't think the fiscal outlook in the near term is going to be a big driver of what the Fed does. I think the Fed's basically going to react to what they see in terms of the risk on the labor market side. So watching the unemployment rate, the payroll employment growth, wages, layoffs in particular, any signs of growing weakness in the labor market are going to accelerate the rate of Fed rate cuts.
So let's get more then into some of the candidates' proposals on the economic side. You had a piece out in Bloomberg Opinion yesterday talking about the high tariffs proposed by former President Donald Trump. You say high tariffs, weak dollar, a recipe for disaster. You write, as long as the U.S. keeps borrowing at the same pace, the policies of higher tariffs and a weaker dollar are fundamentally at odds, and a bigger deficit means less savings, which means the dollar would have to appreciate even more. So can you just sum this up for me in terms of why this economic proposal is so off?
Well, it basically wouldn't work. Trump's basically proposing that I'm going to raise tariffs a lot, and I'm going to intervene and push the dollar down in value, and that's somehow going to solve the trade deficit. But that misses what actually causes trade deficits in the first place. The reason why we have a big trade deficit is we have a shortage of domestic savings relative to domestic investment. The personal savings rate right now is running around 3%. We have a large fiscal deficit, and so we're essentially spending beyond our means. And so we have to import that capital from abroad to fill that savings shortfall, and that capital from abroad is in the form of a big trade deficit. deficit. So if you're president, if you're a candidate Trump and become President Trump, and all of a sudden you enact all these things that are going to blow out the budget deficit even further, that's going to exacerbate the savings shortfall, and you're going to need a bigger trade deficit, not a smaller trade deficit. So the notion that the dollar would go, would depreciate in that environment is probably pretty unlikely. The dollar would probably have to strengthen to generate that bigger trade deficit.
There is so much debate, though, as to whether those higher tariffs are going to be good or bad for the economy and who actually winds up paying for it at the end. Walk me through your thinking.
Well, most economists are pretty, they don't agree on, we don't agree on everything, but we agree on one thing. The tariffs are a bad idea generally, unless you're doing it for sort of strict, for national security kind of reasons, because they basically distort trade. They push you away from doing the things that you have a competitive advantage to doing things where you're probably less effective. They're also bad because the burden of tariffs are not felt by foreign producers at the end of the day. They're felt by domestic households. And what's interesting about the Trump proposals is they would be bad for the core constituency that Trump has attached to him. Low and moderate income households that support Trump would be the ones that would pay the biggest burden on these tariffs.
Is there any way to blunt that impact through monetary policy? I mean, given how blunt that policy is?
Not really. I mean, obviously, if you had higher tariffs, you'd have more inflation, and the Federal Reserve would have to take that into consideration in terms of the monetary policy path that they chose. But, the Fed's not going to make any decisions about this for many, many months. The Fed doesn't set policy based on what might happen in the future. They set policy on what's happening today. So anything, first we have to settle the election, then we have to see what the incoming administration does, and then only then would the Fed start to react to that in terms of how they set monetary policy. So that's still many months down the road.